But I'm from iAfrican. You know, the beautiful thing about deep learning in Indaba is the fact that we get all the business community in AI at the Indaba. And one of the lovely, most important, this is actually 1 year in the making, guys. I just want you to know that. I was supposed to interview him last year in Senegal. And 1 year later in Rwanda, I'm getting him down. I've got him locked down for an interview. This is brother Babacar from Askya Partners. Babacar, how are you?
I'm doing great.
You've been talking the whole day.
Yes, it's been a very long
It's
day.
been main workshop, side workshop. You're going back to another talking plenary session. Thank you for your time. We really appreciate it. Brother Babacar, from your vantage point of view, Asken is I mean, you'll explain it better, but it's an investment firm, right? What is the funding landscape in regards to AI startups, AI businesses on the continent? Where are we getting it wrong? Where are we getting it right?
So thank you for that question and for the invitation for this discussion. I'm glad we can finally do it. I've been excited about the work you do.
Thank you.
So AI funding in Africa, today it happens despite everything. Why do I say that? Today you have very, very few investors that are dedicated to investing in the AI space. So most of it is actually opportunistic. Investors will see a challenge, an opportunity in a sector or another, and they will back a company. But there's not a concerted effort. And that's where we come in. We think there's a huge potential in this space. And it's being underappreciated, whether it's by governments, banks, venture capital funds, and private equity.
No, I fully agree, because there's money on the continent, but you know, people are talking with their mouth but not with their pockets. And it's actually we need to get it much more. We need a much more mature market. And I think one of the institutions or sectors of the finance world are banks. I think banks should be doing more. But walk me through just the different vehicles. So Askya Partners is an investment firm. What is the difference between an investment firm, a VC, and a traditional financing institution? There's going to be a lot of startups and co-founders and people wanting to start that are looking for cash injection. Just break down those different options that one has.
Yes. So this week, actually, we spent the whole week with startups in workshop, masterclass, going deep dive into their business model and seeing how we can get them to scale. Now, this is our role as a venture capital firm. Now, if we think about the different type of businesses that exist within the AI space, let's take first startups. Startups are high risk, high potential opportunities.
100%.
This is the role of venture capital firms. Take the early risk to get them to where they are de-risked, where they can either access private equity or they can access a bank loan so that they can scale much faster. Now, you see, I've just drawn the road. So the second path, once you get to that mid-scale where you may be a big SME, but with a very fast growth, that's when you start become attractive to the banks. And finally, once you're at scale, you can go to the public markets or raise capital from private equity. Now, this is companies. But AI is not just businesses. AI is also infrastructure. And this infrastructure is about data centers, is about GPUs, is about cloud services. Now, those are the spaces which have been invested but in the old economy. This is an opportunity for the banks and the bigger players. We are focused on backing the digital startups that are using AI or producing AI from the continent.
I like how you just explained that, the three different sort of stages. Now, I want you to talk to my founders, my startups watching this. What are the key metrics do investors like Askya Partners look at from that early all the way to that growth stage? What are you looking at? I think it's important for my founders to be conscious of how do I attract an Askya Partners and get funding.
So at the early stage, beyond the metrics, we're looking for one thing: a company with a founding team that is fully dedicated to solving the problem they've identified. And they have a unique understanding of this problem. And they have a solution that is 10 times, 100 times better than what anybody else can provide. Think paper map, Google map. That kind of disruption is what we're looking for. People who are bringing something new to the market. Now, That's just very general, right? Those are the business fundamentals. But what makes a difference between 10 companies that meet this criteria? It's really customer love, customer desperation for the product. It's not about this number, 50% growth, 200% growth. No. What we want to see is customers who are desperate to use this product, even if it is still a pilot, because they need it and it solves a problem for them. Once we see that, we know that there is potential. Then you need to structure a company, a business, an organization around it so that you can deliver it at scale. But that is the most important. And AI or no AI, the AI is a tool. The objective is to solve a problem for an identified customer.
Let's look into the different industries. Askya Investment Firm, rather. Askya Investment Partners, sorry. Yes. What industries are you sort of looking at? What industries are you intrigued by? I think that's very important. So my sisters and brothers at home understand where some of the gold areas they should be looking at.
So first, we don't know the future.
Okay.
But our strategy is to approach the potential of AI as a booster for African productivity through vertical AI and horizontal AI. What is horizontal AI? These are platforms, large language models, anything that can be used by multiple other businesses.
The infrastructure.
Exactly. This is the AI stack. That's what you need for AI to come from Africa. Vertical AI are companies that focus on a given sector.
Okay.
Healthcare, education, financial sector, customer service, etc. Now, we see opportunities in both those spaces. We see opportunities in the AI stack. Why? Because the global solutions are not necessarily tailored to our realities. Unequal access to connectivity, on and off electricity, and the specific, African context of payments. Now, the vertical opportunities, which is what you're asking about, yes, right? Which sectors? Healthcare is a huge one.
Of course.
We're very, very strong believers in healthcare. Why? Because AI fundamentally is about automation on steroids. That's what it's about. We don't have enough doctors, nurses, medical professionals.
Healthcare is poor.
We will never have enough at the rate at which we're training them. Yes, however, AI can allow us to double, triple, quadruple the number of patients that can be treated properly
by
the same amount of
100%.
doctors. So we see a huge opportunity in this space, not just on the care side, but also on the healthcare financing side. One big gap we have in Africa, less than 5% of the population has health insurance. Now, South Africa is an exception where the ratio is much higher, but on the rest of the continent it's quite low. The key challenge for the healthcare sector is its financing. Because with more reliable financing and better spreading of the risk between everyone, that's how people can actually have less health challenges that impact their social position. So we see a huge opportunity in that space because insurance is still paper-based in Africa. There's the opportunity to both digitize it and automate it at the same time. Now, this is huge. So beyond insurance, healthcare, what else do we see? The financial sector is a huge opportunity.
Payments.
Especially lending.
Lending.
Because payments now has enabled us to have all this data about all these people.
Credit.
From that, you can make productive credit to businesses, to the economy. This is $1 billion, maybe even $1 trillion opportunity. Africa is at 20-30% credit to GDP ratio. We can multiply this by 10. We would still not be at the level of the US. So that alone is an opportunity to open a broad array of businesses that are whether specialized or platforms to serve that space. And finally, I think one sector that would benefit really greatly from the automation that AI brings is logistics. Because logistics mobility is, is fragmented on the continent and extremely complex. The opportunity there is to bring transparency, visibility on what moves where so that we can optimize. Whether it is in food to reduce post-harvest loss, to reduce the cost of moving goods, which reduces the cost of, the cost of living in general. And that would have a huge impact on the continent. Economic, from profit perspective, and social.
Brother Babacar, I love how you just unpacked that. Those insights are very critical. Now, I want to move to our founders. a lot of our founders, a lot of our startups don't have experience in raising money. They don't know if I've got the right team, I've got some traction, I'm in the correct field, I'm in health, I'm in this. There's movement going on. But how much liquidity do I give to an Askya Investment Partners in exchange for money? Can you just explain that relationship between VCs and startups? What do I give and what do I get? I think that's very critical.
I really like how you asked the question, what do I give and what do I get? Because this is not just about money. The first thing that is really important that I would advise to founders is don't think of investors as capital providers. The investors are your shareholders. They're your partners in business. And a partner in business doesn't just bring money. A partner in business is somebody you will have to take decisions together with about the business,
Definitely,
including the management. You will take decisions with them about what is your strategy. And you will take decisions with them about, things that are very important, like exits and what kind of other investors we're going to bring in around the table. So you should conceive them as long-term partners who you need to be aligned with from values and what you're trying to achieve together. Very often the frictions with the investor come from this, not knowing what this investor is trying to achieve. And sometimes there's a conflict with the founders. Now, beyond that, a partner also has to bring something to the business. Capital, of course, but that's not enough. They can bring customers, they can bring relationships, they can bring access, whether it's government or brand perspective. They can bring a lot of things. Now, many founders, when they pick investors, they focus on the valuation instead of focusing on the whole package. My recommendation is look at the whole package. How does this investor get you from point A where you are to point B where you want to go? Now, this is what you get. Now, the question that you also asked is, how do we think about valuation? How do we think about dilution? Generally, what we see now, this is a general statement, so there are many specific cases that could not fall here. But the level of dilution of a startup at the early stage, so whether it is a pre-seed round or a seed round, will be between 10% to 25% of the capital. Any investor that asks more than that is not practicing the market standard. Less than that is very exceptional. So what is most important there is to know that this valuation, generally at the early stage, is not something standard. There's no standard number. Investors will say it's anywhere from $1 million to $5 million. But you'll wake up one day and you see one at 20 for an idea stage company. But the team is a stellar team that has already built businesses before. So it's each scenario. And it's
case by case.
Case by case. And first, it's the team and the power of the idea and whether there's a product. Those are the things that determine the balance of power. If you have many investors who want to invest, you can push the price up. If you have only one, well, you do your best and you take what you got.
Babacar, when I have conversations with founders in innovation hubs and in these spaces where they're creating all these wonderful solutions, there's always this debate between local funding and international funding. Now, something as small as, some founders, prefer it just to raise money in US dollars because there's more runway when the conversion rate hits back home. Others, prefer local. What is your perspective on that?
I think, again, first, you have the cards you've been given. You will do your best. You'll speak to many investors. You will have some proposals. I don't think there's a rule to be had local versus international investors. Because in the end, you want people who care about your project
100%.
And bring more than capital.
100%.
And that can be international. You have some US investors that are education specialists. If you get one of those investors on your cap table, it's amazing because they bring you a perspective that is much broader than an investor that is in Africa, that understands Africa, but it doesn't understand education.
100%.
So you have to think about what are the different things you need, which can be regional context or can be, sector specific or global. Now, the one caveat I would put there is Don't put your destiny in the hands of somebody for whom Africa is not core to what they do.
Please say that again. Say that again. I need to hear that again.
Don't put your destiny in the hands of somebody who might, in 2 years, 5 years, 7 years, stop investing in the continent because it is not a priority, but it is a side
It's
thing.
a side expedition.
It's a side expedition. Why? That's exactly what happened, in private equity in the 2010 after the financial crisis. That's what happened in VC after 2020 when, there was COVID and then all the international investors retreated from the continent. It's cyclical. In every cycle, there's a cycle where there's a lot of money, they start exploring Africa.
Yes, sir.
But they're exploring. Now, we can seize that opportunity, benefit from their support. But when they stop exploring, they refocus on their core markets.
Their core markets.
Like they should.
Because that's the cash cow.
Because that's where they make money.
Yeah.
And when that happens, if you're a company and you only have international investors who happen to be retreating, they won't even pick up your calls in some cases. So you have to balance the two.
Brother Babacar, I promised you I'd do this in 30 minutes. I know your time is valuable because you got to go and talk. Advice to young founders, soon-to-be founders, startup teams. What strategic outlook should they have in everything, in the product, in the teams, in the investors? Just let's wrap it up. What should they be? What's that blind spot they should be looking at? It's a loaded question.
That is a very good question. And I cannot say just one thing to that. But the question of what is the mindset and outlook you should have. There is no big business in a small market. If you want to change things, if you want to build something meaningful, you have to go for a big problem.
Okay.
Something that pains a large number of people or businesses.
Because everybody's interested in it. Everybody's vested in it.
Because you can build something big from that.
Got you.
And that is the foundation. It is as hard to build a big business as it is to run a corner shop. The guy running the corner shop wakes up at 4 a.m. Still, he doesn't have any IPO
100%.
or liquidity or millions of dollars. Exactly. It is not the same.
Yeah.
And so you need to start by thinking big. And thinking big about a problem for a specific customer that you know better than anybody else. Okay. That is the foundation. Now, beyond that, this is the what. Now, about the how. You as a startup are competing with everyone.
That's true.
Last year, there were 457 startups that raised more than $200,000.
Wow.
Okay, this number is increasing each year. How many startups try to raise? Maybe 2,000, maybe more. I don't know the number, but I know it's many more than those who got money. So you're not competing with the other startup in your city. You're competing with all of Africa
100%.
for limited amount of capital.
100%.
You have to be the best in the world at what you do. Excellence is the word. You have to be the best. And you have to always strive to improve and get better. Because an investor that says no to you today, you meet him again in 3 or 6 months and he sees a trajectory of growth, will likely back you. Because we're interested in the slope, not the y-axis. If I use some, data numbers, that's what we're interested in. So we track founders over time.
Okay.
We see how they grow as people, as leaders, as founders. And so invest in yourself, invest in your team, get better. Now, the most important thing in that excellence bit, 2 things actually. One is your culture. What is a company culture? Culture is what is rewarded and what is punished in your organization. It's not the values you plaster on the wall. It's what you do. Second, your people are your strategy. If you say you're doing AI, you have nobody who understands AI in your company.
You're not doing AI.
You're not doing AI.
You don't know what you're talking about.
Exactly. And so the level, the quality of the people you hire as co-founders or senior people in your organization set the maximum of the quality of your organization.
100%.
If you hire average people, they will hire less than average people.
100%.
If you hire great people...
And it keeps going down and down and down the ladder.
Exactly. That's why they say hire people who are better than you.
100%.
so that your organization can grow
100%.
and attract people.
100%.
So I would say that is the focus. And finally, speed. Move fast. Don't hesitate over small decisions. A decision that can be reversed should be taken now, and then you will adjust. Focus on irreversible decisions. Take your time for those. But anything else, move fast.
This is one of those episodes that give me goosebumps. Literally, as you speak, like I'm getting goosebumps because you are giving these are key nuggets. You know, so let's talk about founders that have nice problems.
Yeah.
And that's when you have, you tick all the boxes, like you said. You tick all the boxes. Now there's a shopping, there's options now. There's Askya Investment Partners, there's this one, there's that one, and they're giving you different offers on the table. As a founder, as a startup, who do I look at? And where do I lean towards?
That's a very important question. And the founders who are lucky enough to be in that situation should take the time to take this decision, because this is a decision that has a lot of impact down the line. The most important thing is, do you want to work with this person for the next 10 years? Because they will be your business partner. Who do you want to work with most?
That's powerful.
That's it.
Because I got to be with you for every day, all day for the next 10 years.
Maybe not every day, but
yeah. Like,
often,
it's a marriage for the next 10 years.
It's a marriage.
Yeah.
It's not 10 years.
It's not.
It could be more.
It could be more, 100%.
Yes.
Okay. I love that. Short and sweet to the point. Who do you want to be for the next 10 years? Ladies and gentlemen, that is longer than most marriages. I'm going to end it off there. Thank you so much, brother.